So the next thing that I want to talk about, just to finish, to finalize this chapter, I'm just going to recap about some of the new contra accounts that was given to you within this chapter, right? We know we dealt with a couple of contra accounts and we dealt with some new expenses and stuff, and I just want to connect everything, okay? So let's talk about the income statement because that's where most of it was affected. We said that inventory is an asset when you purchase it, but when you sell it, it becomes an expense. That expense is cost of goods sold. Cost of goods sold is an expense that allows you to calculate gross profit. Since it's an expense, it should belong on what financial statement? The income statement, right? So let's just look at how everything was connected, okay? So let's look at this income statement for a second. And scoping may look different because it has some new accounts on there. So the first thing we need to identify always when you create an income statement, revenues. So of course we would have sales revenue. Whatever the number may be. Right under sales revenue should be those new contra accounts that we talked about. There are two new contra accounts that affect sales revenue on the selling side. One of them called sales discount. And the other one is called sales return and allowance. Both of those accounts should do what to sales discount? Decrease it. It should decrease it. You should now be able to calculate your net sales revenue. Now, after we've calculated our net sales revenue on the income statement, our next logical step would be to find out gross profit. And in order to find out gross profit, we would have to deduct cost of goods sold. That would give us our what? Gross profit. And this is fairly a brief explanation to put you up to par of how your income statement should start from now on. Okay? We have two new contra accounts to sales revenue, and we have a new expense that should be subtracted from sales revenue independent of the other expenses to give you gross profit. After you collect gross profit, then you can report all your other expenses however you normally are accustomed to get net income. Okay? So that's the first thing that I wanted to talk about. Let's keep piggybacking on that, and let's talk about these new accounts. Both this account, and this account, both the two new contra accounts and this expense must be added to the closing process. Think about it. We close out all expenses to income summary. If cost of goods sold is truly an expense, it needs to be closed out as well. Now, we also close out revenues to income summary. However, since these contra accounts are like little babies, they follow wherever they need to go with the parent, then they need to be closed out as well. Now, here's what you need to understand. How would you close out revenue? Well, to increase revenue, you have to credit it. So to close out revenue, revenues, right, you would have to debit revenues. But those contra accounts technically affect what? Revenue in a negative way. How do we record them on the books? How do we put them on the books? We debit them all the time. We debit sales return allowance, sales discounts. So the closing, we have to do what? Credit them. So they move in the same aspect as how expenses move. And so the new closing entries, which you would just add to what your expenses would be those accounts. So for example, we know we have to close out expenses to income summary. So when it's time to close out our expenses, we always debit income summary. But what do we credit? All those expenses. Well, what expense you should not forget? Cost of goods sold. And don't forget the other contra accounts. Sales discount sales, return, and allowance. Right? And of course, if you had other expenses, you will close them out as well. But these are your new parts that needs to be added to your closing entries. Okay? The only other quick thing that I want to mention is that all of this information I've taught you was how to account for stuff from the perpetual aspect, right? The perpetual. Remember, with the perpetual system, we don't wait to the end of the period to start adjusting the books and the records and stuff, right? We adjust it as it happens to give us an accurate, updated balance for inventory. However, at the end of the period, we still do a physical hand count. We still go and do a physical hand count just to make sure that what we counted left, the value of what we counted left, should match the ending inventory value that we have on the books. And if we don't, we know something happened. A lot of logical explanations, right? Theft from internal theft from some of our employees. We probably our own people steal from us. Or it could be from customers, right? Or stuff could just happen. And so what happens whenever your physical hand count doesn't match to your books? You always adjust to the physical hand count. You always adjust to the physical hand.